As a beginner investor, you might be wondering, what are mutual funds? In this video, I'm going to explain the basics so that you can get started on your investment journey. Before talking about mutual funds, we need to understand what a fund is. The short version is that a fund is a collection of assets, such as stocks and bonds. If you'd like to hear the long version, pause this video and go watch my investment funds for beginners video, link for that in the description. So what makes mutual funds different from other fund types, such as index funds and exchange-traded funds? A mutual fund is actively managed. The provider who creates the mutual fund, such as Vanguard or Fidelity, are hands-on, meaning there are real humans working away to ensure the mutual fund makes its investors and the provider wealthy. Imagine a mutual fund which is focused on the gaming industry. Let's say it's a collection of the 50 biggest gaming company stocks. If one of those 50 gaming companies is about to fall off a cliff, and the clever humans managing our fund predict this event, they will likely sell off all holdings of that company before its stock price nosedives. In this scenario, the active management of our fund may have just saved our investment. The humans managing the mutual fund will have impressive degrees in finance and economics, and will be using their knowledge of the real world with full context to try and beat the market. If a mutual fund successfully beats the market, then it means your returns will be better than a typical investment made elsewhere, such as a passively managed fund like an ETF. To quickly recap, here's the key info. A mutual fund is actively managed and is run by humans who are aiming to beat the market. Confusingly, index funds, which are typically passively managed, are a subcategory of mutual funds, which we've learnt are actively managed. This can make understanding the distinction between the different fund types confusing, so let's simplify it. Would I recommend investing in mutual funds? I don't think that's simple enough, so let's try again. Would I recommend investing in actively managed funds? No, and here are 3 simple reasons why. Reason 1 is higher fees. You're paying for a well-educated human's time, which is always going to be expensive compared to a passive fund, which is run entirely by algorithms. Reason 2, the fund manager is incentivized to make the most money for their company. This can often mean trading regularly, sometimes every day, and those trading fees are passed on to you. It's incredibly common for actively managed funds to actually lose money relative to the value of the currency over the long term. This is partially due to the constant trading, which can lead to high fees. Reason 3, and this is a slightly cynical one, do you think a human can make a better decision than a computer over the long term? I personally don't. Perhaps a human can make a quick judgment to sell off that gaming stock we mentioned earlier, but even with that possible advantage, I'd still favour algorithms over the long term. We have to remember that machines have no emotion and can make better judgments because of this. Additionally, computers were just designed to be good with numbers. There is very few humans who can compete with a well-designed algorithm. So tell me, what are your opinions on mutual funds? Thanks for watching Money Champ. I'll be releasing videos on index funds and ETFs shortly, so hit subscribe and I'll see you next time.